My dear friends, welcome back to live trading with Morpheus. Today I'm going to be super excited again to present you with proof that market is not chaos and that when trading by the book, you're quite capable of making money without relying on luck, but on consistent basis with logic, math, and statistics. So let's take a look. Today, actually, I had a little bit of technical difficulties, but if we take a look at this week's Forex calendar, we see that today, Wednesday, May 21st at 9 a.m. GBP will create a movement, a spike in there's my internet giving me a bit of issue. Love Cyprus, but the fact is that sometimes there is a bit of a problem in with the connection. But we see that in 3 minutes and 25 seconds from now, we're going to experience a spike, a movement in the market with from the GBP, from the Great British Pound. All right, let's take a look. There we go. The internet, it should load. Give it a second. We're going to still take advantage of it. We're going to make some money on it. There's going to be a impulse. It's going to be going up or down. We're really not quite certain. There it is. Thank goodness. All right. Today, let's see if we can able to take advantage of a pending trade as well. But first, we need to pick the right kind of currency, right? Let's take a look. GBP. There we go. Let's GBP. There we go. Real market, I think is 70%. It's kind of low, but let's take advantage of it, just to see if we can anyway. All right, so GBP, JPY, there it is. All right, and actually, I think I'm going to do it like already, right? Now, GBP. Yeah, alright, let's pick the amount. Let's go for like $10. Nothing crazy. $10, there it is. And we see the rate 192.89. Let's go with the 86. 86 already, right? 192.85, 86. Well, let's go for a sell with an 86. And let's go with a buy with a 94. All right, so what we've done, actually, I'm looking at like a really big here. Let's go 1 minute. We've created a channel here, right, for a buy position. If the asset reaches this point and higher, it's going to activate a buy order. And there's going to also be, let's put like maybe $50 here. For a retracement is going to be for 1 minute, right? So for 60 seconds, 1 minute, that's the least that you can do. It can't really go any lower. But if it reaches, right now, the release is going to happen. We're doing this like super fast, right? There we go. In the next minute, on this candle, at the end of this candle, there's going to be a spike, right? There should be a very aggressive movement upwards. And it should activate, if it's going to be upwards, it's going to activate the buy order. And all we have to do is right now we have two. So when it activates a buy order or a sell order, well, I guess it did a little bit. I should have done that maybe a couple of minutes or a couple of seconds before. But because of technical difficulties, I kind of rushed a little bit. And it activated this particular order. But if it was during the spike, and we can still maybe, let's kind of go this again, right? Right now it's 187. Let's go to maybe 186, right? 86, and let's do another sell, just kind of like to get the point across. 5 seconds or so before there we go. So the spike, there it is. All right, so it did activate the buy order. We opened for a retracement. All right, and then we're going to, right now, maybe we're going to go actually to a double that. Actually, there we go. Let's see if we need that. All right, so a spike happened because of the CPI. It's actually a very, very important statistic in economical growth. So right now, see, we did have a position activate, and I might actually open another one if it pushes up a little higher. You know, I might open up another one actually. Let's do that. So 150, and 300 loaded for a retracement. But look what happened. If we had a channel here, right, for a pending trade, we have a channel, and right before a spike, which we don't know which direction is going to go, but right before a spike, we can open a buy and a sell order for like maybe I would say, I don't know, well, what would you say, maybe like for 3 pips or so. See, there we go. The trade activated and it was, in the money. Right now, yeah, it looks like our 50 trade didn't really quite go through. The retracement usually happens on the first minute, but if the statistic is somehow like, very noticeable, very good, it could carry over to the following minute. And that's why we're putting here a timer instead of end of candle. And here in the pending orders, there's also, 1 minute trade. So let's revisit essentially what we've done. All right, so let's see. I did lose. I opened it only for $1 instead of 10. All right, so it looks like I've lost $11 on the pending trades. But I've won $17, right, or on the winning trade. So in a sense, I've lost 11, once and well, essentially got 7 here, right, profit. So a little bit of a mismatch. So here I lost 11, made 7. So $3 loss. The retracement was a little bit too late. I think when it spiked up a little higher, I should have opened it here instead of at the bottom, but we understand that after a big spike, there's going to be a retracement. So when it pushed up a little higher, I did open for a bit higher position, and what it worked out to be with 79% payout on this, in this situation, was a little bit better than the previous one. I got $79, so I lost 50. I won 79. Well, $29 in profit, and here I kind of lost like $4, so $25 in profit in in approximately a couple of moments in a minute. Um, this is kind of an important aspect to understand that it wasn't a surprise. We knew about this, right? I told you about this in the beginning of the week. When if anybody goes to our channel, Telegram channel, you see the schedule for the week. Essentially when we're going to be meeting together and what we're going to be discussing. I do a little short announcement about that, and I've told you about this in the beginning of the week, so that, Monday we talked about leading and lagging indicators. Yesterday we took advantage of the CPI from Canada, and today we took advantage of CPI from Britain. All right, tomorrow, also just a little bit later than today, we're going to take advantage of 2 events. There's going to be manufacturing and services PMIs from France and from Germany. All right, so this is kind of a cool thing because tomorrow there's actually jam-packed full of these events. We got, as I mentioned, France and Germany. This is was second strongest economy in Europe, and Germany was the first. But there are some geopolitical kind of issues with that now. There's going to be, there we go, same thing with the GBP. GBP is the most volatile of all currency pairs. You guys need to know that. Um, and there's also going to be the USA, right? The United States dollar is going to be affected by same statistics, same macro statistics. So, I'm kind of hoping that, wait a second, I just noticed the chats. Uh, my 2 favorite guys over here are with me again. Donald, right, my man, and Henry. Henry, very, very good of you guys to once again hop in here and share some of this with me. So, any kind of questions, comments, or concerns from any of the viewers right now? I'm going to give you a full answer. This isn't going to be like a BS thing. I have quite a bit of experience working for 2 biggest brokers in the world. Being a trader myself, I can kind of tell you all of the in and outs of the system. Yes, you're able to make money. No, you don't need luck. You need very, very specific understanding of what you can ask from this instrument, right? From binary options. People often, kind of have a bit of, I don't know, fear of trusting this. The thing is that it's not a bad instrument. It's how you use it. All right. So we all understand support and resistance levels, right? And if you don't, touch base. I'm gonna make a video about this later as well, or a stream about this later as well. Me and my team are working a bit right now on a course that you guys are gonna be able to peruse at your leisure from, kind of like a general understanding. But if you want specifics, this is something that's available one-on-one. You want to make money sitting down, at your home without going anywhere, or at the beach if the internet connection is good enough to do that. Let's talk about this. Let's give your, kind of dreams an opportunity to take off. All right, this is what allows it, but we also need to understand that this is an instrument that can significantly improve the speed of you reaching financial independence, but you can't ask too much of it too fast. And this is where people usually make a mistake. They think that, oh man, 79% or like 92% with the OTCs. I can have a Taj Mahal and like 20 Ferraris, by tomorrow. You know what? There is that possibility if the God or, the universe, let's say if the universe smiles on you and you just close your eyes and push some buttons and, up, down, up, down. You know what? There is a chance that you might get this, like, $100 into 100,000 in like matter of a couple of, minutes. But that's not trading. That's gambling. We all understand that but one of the things that we will talk about during the streams, I'll answer any kind of questions about, is psychological control. I've talked to thousands of people, thousands, like literally, that's not an exaggeration. I started talking to people about this since 2012, all across the world, from India, from United States, from Europe, from Asia, with a little bit difficulties in Asian market because of the English, barrier. But nevertheless, I talked to thousands of people, and I am able to share with you not just my ideas and thoughts about emotional control, but I can pass on this experience, their experience to you as well. There are so many different strategies about, from trading, but coming back to the original point I'm trying to make here is that you have to know what you can ask from the instrument with regards to now. Right? I think yesterday or the day before, I might have mentioned if I gave you 100% guarantee a month that you're going to get a successful trade, you know what? I highly doubt that anybody would trade different times other than that one time. You would sell your house, your car, your cat, your, I don't know, blood, spit, whatever. You would sell all of that and you would invest it into that one-time position, get your 92% or like 80%, almost double it, and you would immediately buy everything back and have this like nice chunk of change left over that you would probably put all in on the following month into that one guaranteed chance. The thing is that there's no such thing as one guaranteed chance. But what if I told you again, right, that there might be two 95% chances of success? Right? It's a different statistic. It's a different math. It's the different math is involved, and logically you can apply your finances to make sure that you reap the rewards. But even with 99% chance, not even 95, 99% chance, there's still that 1% that something will go amiss. Right? Today we understood that there's going to be a spike. We understood that there's going to be a retracement. There it is. There it is. I'm showing it to you. It's real market, right? You're looking at GBP, JPY. It's not OTC. You saw it. You saw it like 5 seconds right before. Right now, we didn't do the countdown today like we did yesterday, but we'll do it again tomorrow, right? At 10:15 GMT plus 3 time, 10:30, we will see this again. We'll see a reaction. So we know about it ahead of time, right? You don't need to be clairvoyant for this to happen. And, based on technical analysis and everything like that, understand that people drive the market, right? The buying and selling that affects the supply and demand principles is not just in the real market or OTC. It's both, right? In OTC, we pocket option traders, and there's millions of us, that buy and sell affect the supply and demand principles and essentially pushing the price up or down. All right. But nothing is done there according to a we're not all following the same strategy. We're not all following the same, logic. Not all of us have the same psychological fortitude, right? Logically, we understand that we should have like 3 or 4 steps martingale and no more, right? But if somebody if somebody gets a signal once every, like, I don't know, 3 hours, and they've lost once, they've lost twice. At the end of the day, they just might throw lots of money without any kind of logic into a position, but they're buying a position. That means that they're affecting the supply and demand principles, and doesn't matter really against, based on the pattern or technical analysis, that there's gonna be exactly something that you're expecting. So when we factor that in, right, even when we understand that, yes, there's going to be retracement, usually it's in the first minute, all right, and you know what, we see that there is a bit of a retracement, right? It went from where was it, right, around 192.85, let's say around 85, right, there it is, and it went all the way up to 193, 131, right? So, but then it retraced, right? It did retrace to a bit. I think that this would be like, maybe, I don't know, a 10%er, right? If this would be a 20, 30, 40, maybe actually even a little bit more, maybe like 15%, it retraced, right? But we can see that in the timer, if you open it, it went down significantly lower afterwards. So it had like almost like I would say like 60, 70% retracement, right about here before it kind of bounced around a little bit and continued upwards. So actually, wait a second, let's take a look. CPI, it's actually positive, right? 2.6, 3.3 was forecast, came out at 3.5%. And, so that was good news for the GBP. That's why you see a big candle here, followed by retracement. Somebody that opened the position here made some good money here. And they said, hey, I'm going to sell it. I'm going to close it. And at this point, there was a pullback, a retracement. That's so what the retracement is people taking out their money, taking out their cash, taking out their profits. That's it. Now, GBP. Actually, we have GBP JPY. Actually, interesting. I picked it because it was the highest profitability, but it is interesting enough that GBP is the most volatile of all currencies, while JPY, it's the least volatile of all currency. It doesn't mean that JPY doesn't go up and down in value. It means that it has a parachute from the government. There's not, right, on the government level, it is actually stated that it shouldn't have the ability to create a very, very drastic move, right? That's what volatility is. It's not like something's going up in the trend, right? It's actually, it just means that it goes da 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 whoosh, right? And that's what big, big impact on people's pockets. So in JPY, it does go up, right, or it does go down. During COVID, all of the currencies were falling down, but kind of like rocks, actually, because white people were not spending. This is actually very important to understand. Market moves up and down when people, real market, right? When people feel comfortable in spending their money or not, right? Two, essentially emotions drive the market. The fear of losing money and, well, it's kind of ugly word, but greed, right? Desire to make money. So desire to make money, fear of losing money, that's what drives the market. So, during these events, we understand that people have a statistic to, I don't know, to relate to, right? So they're like, oh my God, I mean, this is great. Inflation is going up. Why is that a good thing, right? CPI, Consumer Price Index, how consumers affect the index, right? Well, essentially the price of goods and services. This is kind of cool. How you do that? You do that when you spend money, right? Let's create a little situation just so guys understand. Just bear with me. Henry, Donald, just hang with me, guys. Let's assume that you guys are the owners of a bakery store, right? Or bakery shop, whatever, right? The bakery. And you come at every evening, you come to your store, you see how things are going to collect the money, and you realize that your shelves are empty, right? Your customers have bought out everything, all of the goods that you had for sale for that day. And you also see that people come in and they're leaving disappointed. And you're like, man, if they find satisfaction with your competitor, they'll never come back to you. Right? So what you as a good business owner at that point might think of doing is expanding. Right? And you might say, hey, I'm going to go to the bank, I'm going to borrow $1 million, and I'm going to spend it. Where are you going to spend it? You're going to spend it on HR, human resources, to find you a chef, a pastry chef, another one, right? You're going to hire another employee, more employees. You're going to contact the real estate agent to maybe bring you into a bigger place. You're going to, I don't know, contact the factories that produce your kind of equipment, specialized equipment, to order bigger, better, more powerful equipment. Right? So you're going to spend that money. You're going to go to the bank and you say, give me $1 million. They're going to say, okay, great, here's $1 million. In 2 years, you're going to pay $1,200,000. And you're like, that's great. That's fine. That's reasonable, whatever. Let's assume that that's the case. And what's going to happen, though, is that you're probably going to increase the price of your goods. Not by a lot, right? So a bread that cost $1, now it's going to cost $1 and, I don't know, 3 cents. So you're going to pay off that loan in a particular period of time with interest. And you're going to say, hey, that's good calculation. I think I might be able to pull that off. It's going to be great. That is inflation of prices, price of goods and services. Why in 1960s in America, a Ford Mustang cost like $4,000 and today it's like 40 grand? All right, because salaries back then was significantly slower. Inflation rises much faster than the salaries. So what the government does to curb that, right? So you don't have a piece of bread that costs $300 when your salary is $500 a week. All right, what they do is they raise interest rates. Right? They raise interest rates because if CPI shows a very drastic increase, month after month after month, at some point, usually it's once a quarter, right? They'll raise the interest rates by 1/4%. Usually it's done by 1/4%, but if the inflation rises too quickly, they'll raise it, by 0.5% or even, maybe higher. What this does is that you, as a business owner, you go to your bank and you say, hey, I want to borrow $1 million. And they're like, great, here's $1 million. In 2 years, you have to pay back $2 million. You'd be like, whoa, that's a lot. That's a lot to ask for. You're not going to be able to increase. You have to do some calculations. And you're going to say, hey, you know what? If I increase my piece of bread from $1 to $5, nobody's going to buy it because competitors are still selling it for $1.03. All right, or $1. Point is that at that point, you might think, hey, you know what? I'm going to gather some of this money that I have left over, savings account. I'm going to invest it into the bank because the interest rates are so high, right? That it doesn't make sense for you to borrow money, but it makes sense for you to invest money into banks, right? So what this does to the currency is that there's, what we're looking at is a currency pair. It's an international exchange, foreign exchange, Forex. And it doesn't matter whether you're in binary or in Forex as an instrument, the currency pair, it's, if it goes up, on our platform like MetaTrader, if it goes up, it's just a different instrument to pay you, different way of paying out. So it's still the same graph, pretty much. Now, here's the interesting part, once again. If I'm in Europe, and I get, I have a certain savings account in my European bank, and which I do, uh, and I get, let's say, like 2%, just a little bit higher than inflation. Let's say 3%, for the sake of this argument, 3%. Bank is paying me 3% interest on me keeping my money in that bank. Now, I all of a sudden see that in America, they're paying out 6%. Right, double of what I'm getting. Well, what I'm going to be interested in doing is selling euros and buying the dollar, right? Exchanging euros into dollars. When you exchange, you're selling your currency and you're buying a different currency. Again, supply and demand principles are in effect, which means that I'm selling euros and I'm devaluing euro when I sell it. Not one person, but I'm pretty sure I'm not going to be the only one to say, hey, I'm going to get much more money if I have dollars than euros, right? And when I buy dollar, I'm bringing the value of it up, right? So this is actually kind of a very, very important thought in this. Any macro that we take a look at, right, there we go, let's see it. Any macro statistic that we take a look at for any country, it really determines how how people are spending money. If they're spending money, that means that the value, that the inflation is going to be going up and the central bank is going to raise interest rates. Or if they're not spending money. All right, if the economy is not doing good, if the people are being laid off left and right, you're not going to buy new patio furniture. You're going to say, man, I should save money, just in case it's a rainy day. If I get fired, I should have a, little safety net. This is essentially what this is all about. All of the macro statistics, they're not like something that kills or, launches their economy into the space. It's just kind of showing you a little bit where the spending is, right? If is it happening? Is it not happening? And at that point, there's certain geopolitical situations that are unraveling in the world, might give you a bit of a clue to where the economy will be going. A war is expensive. Naturally, people are not going to be investing into an economy that might be, obliterated by a war, right? A natural disaster, right? It costs money to repair, to save people, right? So, the currencies are affected, right? The NFP was negative, right? NFP means non-farm payroll. It usually implies how many new salaries are created. So, people that are turning of age, they get their first job and the new salary, the paycheck is paid, and what they do, they go and spend it. All right, or people go on pension. They say, I'm done working. I'm going to relax the rest of my life. I'm going to, live a little bit differently, right? So, but NFP is new jobs creation, right? That's essentially it. If there's more people getting their first jobs, their first paychecks, it means more people are working. Unemployment is going to be lowering. People are going to be spending their money. Economy is going to be great. More taxes, more expenditures, inflation go up, and all of that is a good thing for the economy. That's where the government might say, "Hey, you know what? We're growing too fast. We need to curb that a little bit by raising interest rates. That's going to attract foreign investing and is going to strengthen the dollar." Excellent. But the NFP was red, in the red, in the negative. And you're thinking, how? How is that possible? It means that during the flooding of New Orleans, actually, I don't really get why. It doesn't really make a lot of sense to rebuild an area that is getting prone to flooding. But nevertheless, human spirit, ingenuity, maybe they're doing something with the levees differently, and that's not going to happen again. But when that happened, right, you understand the dollar is going to take a bit of a fall because there's lots of money being spent on, within the country being spent on something inside, right? So there are spending, but there's nothing really kind of returning it, right? There's no return on investment in this case, right? Anyways, this is something that we, kind of need to keep an eye out. Okay. Uh, Man, I love talking, but you know what? I love answering questions even more. So, if anybody is kind of like hopping in, except for, Henry and Donald, you guys are my peeps. Ask questions right now in live format. I'll answer about the topic or, about trading. Maybe you can contact us, my team, our team in Telegram channel, or leave a comment. This is something that's super appreciative. All right, my dear friends, I'm going to, I don't know, let you go for now, but hopefully tomorrow I see you for the manufacturing PMIs. We're going to we're going to take advantage of two of them. Today we took advantage, well, we tried, I kind of goofed it up a little bit. I'll show you again the thought process, the idea of pending trade orders. And I'll explain tomorrow why it's not risk free. There is a risk, and I'll show you essentially how to spot it, or rather what to consider. All right, and the pullback. Pullback will happen. There's going to be a spike because somebody's going to cash out their profits. The pullback is going to happen. Whether it's going to happen on the first, on the second, or on the third minute, that's a different question. But PMIs are not really as important as CPI or kind of like unemployment statistics, right? Like NFP, which is the most popular macro statistics of the month. All right. So, my dear friends, once again, I'm going to let you guys go. There's no questions at the moment, but hopefully I'll see some comments. And